Hey, Bobby Trades! I want to do a video analysis update that's a little more laid back, a little more loose, a little more of a live stream format. Now, I'm not going to actually do a live stream because, one, I'm not a YouTuber. I really am not. I don't know how to do live streams. I don't know how to make fancy edits. I don't know how to do any of that. Okay. Two, live streams. People can give you super chats. People can give you tips. People on Twitter now, you can get a super follow. They're getting all these different kinds of ways, for people with social media accounts to really monetize, what they're doing. I don't think there's anything wrong with that. I really don't think there's anything wrong with selling a Discord or a newsletter or, doing, super chats or anything like that. For me, I look back at the past year and a half, 2 years, and I think if I've been running a customer service-based business, I wouldn't have had the time to do all the research that I've done, all of, the work that's gone into this, where I've almost been able to take the vigor of a graduate student or, some doctoral candidate and really kind of hone in on, my field of study, which, I would say is Elliott waves, but also the options mechanics and also just risk management in general, portfolio theory, all that great stuff, right? So what I'm trying to show is that for the past 2.5 years, or really the past 2 years, I'm honestly losing track, I've been neurotically studying the options market. And I just want to show some proof of that. So this is the folder that I have in my notes called Experimental Finance. Now, as you can see, it's not the only notes folder I have. This is dedicated to options. This Replicate the Greeks is dedicated to options. Low IV rank and percentile plus low lot size is dedicated to options. Straddles that will make XYZ amount of money is dedicated to options. And each of these are pretty lengthy folders. And I can say this one, most of the straddles that I wrote down were pretty unprofitable. This one, it was a little 50-50. But by the time I got to Experimental Finance, which is the current folder, and Replicate these Greeks, it started to get very systematic. So after basically a year of doing this, I really started to see kind of a formula for what I wanted to get out of a profitable option straddle. So I'll tell you guys some things that I'm looking for. I'm looking for a stock, preferably a sector ETF or a value stock between $10 to $15. I'm looking for stocks with close to 0% IV rank and percentile. So that's not the end all be all. That's just a preference. And some of the liquidity filters that we go over. And it got to such a systematic point where on December 29th, I saw ET on one of my favorite option screeners. And I saw that I could buy the 8 call and the 8 put expiring in July for a total of $188. The gamma would have been about 15. The theta would have been 0.0025. So theta is 0.0025. Gamma is 0.15. I just took the decimals away when I was writing what the gamma was. But I wrote down this should do well. And the reason I thought it should do well was because I'd been studying the option Greeks for so long. I knew that this was a very low lot size. This was a very high amount of gamma. And this was a very low amount of theta. And given what I'd seen from the option screeners, I thought this was going to work pretty well. So anyway, another one very interesting that we can get into is Deutsche Bank on 12/23. I wrote down, I think that this one could do pretty well. I had a few reasons why I was expecting a big move, but the biggest one, 0% implied volatility, rank and percentile, I believe with Credit Suisse as well. I wrote down, what could have been bought. There could have been a 12 put and a 13 strike call, that expired in July. That could have set me back $197, but that would have been worth $322, just on a directionless trade by February 3rd. And the ET straddle from December 29th to March 4th could have been, almost a 100% return. So I got very used to what I was looking for and why I was looking for it. I wrote down a metaverse straddle. This isn't the one that I currently own, but I wrote down a metaverse straddle on 2/15, February 15th, where I wrote down exactly what the implied volatility was. And I wrote down, what the call and the put would be worth. And, that ended up being a successful one. So I even got to the point where I saw where straddles were being successful, where they weren't, and I was writing them down, and I really got a feel for what Greeks I was looking for. And the whole point was that this took over a year and a half of, really just honing down on studying straddles. And that's something that a lot of people don't have time to do. So I'm going to try to explain, just kind of the little basics of what I've kind of come up with. I'm going to go over my favorite option screeners and all that I think is important for, analyzing what's on these screeners is just saying institutions are betting these stocks are going to have a large move such that they could take a directionless position by buying a call and a put, and without picking a direction, they could make a profitable trade. So that's obviously a pretty big deal if someone can make a big profit without even picking the direction. And so we got to make sure the MMs are on our side. I'm not in one of these trades by myself, holding the call and the put, being the only person who wants that stock to move. I want to make sure the big money has a lot more to lose than I do. Anyway, let's look over some of these screens. So number one and really it's just number one. I use the Straddle screener and the Strangle screener. You guys know this. The long Straddle and the long Strangle screener, I've probably spent 90% of my waking hours on these screeners. So if we look at the long Straddle and the long Strangle screener now, let's just look at it. I'll show you guys some stuff that I'm looking for. I generally look for stocks that are in the value sector or ETFs that are kind of composed of, a group of stocks. I'm looking for general implied volatility to be below 40 or 50%. So let's talk about what makes a good straddle. A good straddle is going to be a straddle that has very high gamma and very low theta. Okay, so which of these stocks, if you just had to guess, let's take a couple of these. Let's take Vail, let's take Ford, and then let's take Amazon and Tesla. Which of these stocks, if I was going to buy a straddle with the same strike price, the same expiration, between Tesla, between Apple, and between Vail and between Ford, which of these stocks would have the most amount of decay if I were to buy a straddle? Well, the answer is pretty clearly Tesla. Tesla is $882. So if I'm going to buy an at-the-money call and an at-the-money put, that's going to cost a ton of premium, and that's going to have pretty rampant decay. Okay, so what's another reason that Tesla, besides the fact that it has a very high dollar amount, what's another reason that Tesla options would have a pretty high amount of decay and lower gamma than, say, Ford or, say, Vail? Well, if we think about Tesla, it's a stock that is extremely volatile, right? Tesla is a stock that can go up 7% one day, down 7% the next, right? So gamma measures the rate of change of an option's delta. So delta has a few definitions. One of the definitions is that delta measures the probability that that option will expire in the money. So a stock like Tesla, being a very volatile growth stock, if it goes up 6 or 7%, there's a reasonable possibility it could retrace that entire move. Now let's think about maybe a more value-related stock like Ford or like Bank of America, right? If Bank of America goes up 6 or 7%, how likely is it that it's going to go retrace that entire move, within the next week? It's possible, but because Bank of America is a value stock with a lower beta than Tesla, it's going to have a lot less likelihood of just retracing a 7% move after it's already gone on a 7% move. So for that reason, when a straddle on Bank of America starts to move up 6 or 7%, the delta of that call is going to increase pretty rampantly, where there's going to be a very high percentage chance of that call expiring in the money at the time of expiration, because Bank of America is a lower, a less volatile stock. Right, so there's more probability that Bank of America won't retrace that move by the time of expiration. Where with Tesla, it could go retrace that entire move. So it's going to have less gamma, because gamma is measuring the rate of change of an option's delta, and delta is measuring how likely a stock is to expire in the money. So that's just one kind of aspect. A little more that I wanted to talk about was, let's talk about a stock like Ford. Let's talk about what could happen on a stock like Ford in the value sector. So let's look at some of these fundamentals real quick. We see Ford's price to book ratio is 1.46, not priced for too much growth. It's 46% above its book value. If we look at the beta right now, Ford's beta is 1.33. So it's 33% more volatile than the S&P 500. We see the implied volatility right now for Ford is the implied volatility for Ford for the next year is 38%. So that means that the options market is pricing in Ford to go up between 38% to the upside and between 38% to the downside. And that's kind of a range that's being set by the options market. So just kind of generally, if I expect for some reason that in the next year Ford won't just move 38%, that it will move 50%, right? It's going to, because of the spending bill, because of, the midterms or whatever, that Ford's not going to have a 38% move in the next year. It's going to have a 50% move. Well, then I should buy a straddle because I'm anticipating a larger move than the options market is currently pricing in. So that's kind of what this shows. If Netflix has implied volatility of 44%, then in the next year, if Netflix is trading at $97, the upper bound for where Netflix is expected to stay within is $140, and the lower bound is $54. So that's kind of, one way to view what implied volatility is. So the implied volatility right now is 38%. The 1 year low is 33%, and the 1 year high is 65%. So it's important to note that if I were to go buy a straddle on Ford on November 9th, 2021, I would have been buying it when options on Ford were the most expensive they'd been in the past year. And if I'd bought options, or if I bought a straddle on Ford on September 2nd of 2021, when implied volatility was 33%, I would have been buying options on Ford when they were the cheapest they'd been in the past 52 weeks. So as an option straddle buyer, I want these implied volatility ranking percentile numbers to be as low as possible. So that's a relative way of measuring implied volatility for a stock. But what about general implied volatility? Well, if we look at Ford, the general implied volatility right now is 38%. For a straddle buyer, that's not too bad. That's not too bad. They want a straddle buyer is generally going to want implied volatility to be low. And the reason that is because implied volatility, when it's low, has higher gamma on the options and it has less time decay. Okay, so it has less time decay and it has higher gamma. Both of those things are very good for the option buyer and they're very bad for the option seller. So let's say that the implied volatility rank and percentile was 0%, and Ford's implied volatility was 33%, at the 52-week low, and Ford was trading at $15. Who would be better off? Someone going in and buying a call for the 15 strike and buying a put for the 15 strike with, say, an expiration in 6 months, or someone going in and shorting the 15 call and shorting the 15 put for an expiration that's in 6 months? Well, it'd probably be a very bad idea to go short the 15 call and short the 15 put, because the option seller would be doing it when implied volatility is the lowest, when theta is the lowest, and when gamma is the highest. On the flip side, that would probably be a pretty good recipe for success for a straddle buyer, especially if Ford is on some of these liquidity screeners, which we'll get into, okay? But I want to say one more thing about Ford. If we look at Ford right now, just kind of a little history, let's talk about the Elliott wave count for a little bit. Now, this isn't an Elliott wave video, but let's just focus on this cycle from the March 2020 low. Okay, so we have a impulse of structure that looks like it's subdivided into 1, 2, 3, 4, 5 waves. Now, if we look at the weekly RSI, we can see when Ford goes and makes this big thrust higher, it does so by making a new high on the weekly RSI. That suggests that this whole impulse, this whole cycle from the March 2020 low is not a big wave 5. Most likely, it's either a wave 3 or it's a wave 1. So there's a rule in Elliott wave theory that says wave 5 must end with momentum divergence. Since on the weekly RSI, this high is made with a new high on the weekly RSI and a new high in price, it means this probably shouldn't be labeled a massive wave 5. It's either going to be labeled a massive wave 1 or a massive wave 3. So that's Elliott wave theory. Okay, I can't tell that to my broker. But what that generally means is that once Ford started pulling back, there was a pretty high likelihood that it was going to go at some point in the future break above this high of 25.87. And I still believe that we are going to go see Ford break above this high. But what I want to talk about a little more recently is that we saw Ford on the Straddle and Strangle screener a lot when it was at the $14 or $15 range. And then what happened? Ford had a dip. After that, Ford had a dip after it looked like institutions had been buying a lot of straddles at the $15 to $16 range. So let's pretend that someone had bought a 15 call and a 15 put on Ford when it was at $15, $16, and then it dipped down to 10, right? So if I wake up, one morning, I've got an in the money put on Ford that is $4 or $5 in the money, right? Let's say I have a little bit of cash on me, and this put has basically close to 100% chance of expiring in the money. Let's say the delta is 95. That means that the options market is anticipating, given that this 15 strike put is $4.50 in the money, the options market is anticipating that there's a 95% chance that Ford will not close above 15 by the expiration date. Now, it really doesn't matter too much what that expiration date is for, an option that's that deep in the money. But generally speaking, well, really kind of almost always, the option with the closer expiration, all else being equal, is going to have the higher delta and the higher gamma, because the closer the expiration date is, the less time there is for Ford to retrace the move. Okay. So let's say that I've got a put option. Let's say it expires in January. I'm making some money on the straddle, but I want to think a little bigger than making money on a straddle. I've got a put on Ford. It expires in January, and it's $4.50 in the money. And I think Ford's going to go make new highs. I think Ford's a big winner, right? What might I do besides just taking profits on the straddle? What I could do is I could take some cash that I've got on the sidelines, and I could look at that in the money put, and I could look at the delta and see that the delta is negative 95. So that means if I wanted to, I could go in and buy 95 shares of Ford that is quote unquote risk free. If Ford keeps dropping, then the delta will increase to 100 for the put. And since 100 is more than 95, there would be a more downside exposure than upside exposure, and I'd still be making money if Ford kept crashing. And in fact, I could even add 5 more shares when the put delta hit 100 and just have an entirely delta neutral trade where I've got 100 shares of Ford and I'm trading it against a put that's got a delta of 100. Okay, so let's say that when the delta was 95, or the delta was negative 95, as I should say, if I bought 95 shares of Ford and then Ford starts to recover, well, then the gamma is going to kick back in. And as Ford starts to increase to the upside, the put delta is going to become smaller and smaller. It's going to go from having a 95% chance of being in the money to having, let's say based on the gamma, the gamma was 10 and Ford went up $1. Now it only have an 85% chance of being in the money. Let's say the gamma increases a little more to 13 or 14 or 15. Now the gamma for the next dollar higher is going to cause the delta to go from, say, 85 to, say, 60. Well, if the delta goes down to negative 60 and I bought 95 shares when it was at negative 95, then I now have a net long position. And that means that I'm making money as Ford goes to the upside. Okay, so that's kind of, maybe one reason. I think a lot of people look at straddles and strangles and they only think about, well, how is this going to make money? And with the right Greeks, with the right filters, they will make money, in my experience. But the bigger thing is to understand the institutions are thinking a little bigger than that. Institutions are using these straddles to pre-hedge positions before they enter them. So what I expect happened to Ford, and we'll see how this plays out, is that they bought a lot of straddles when Ford was at 15 and 16. When Ford fell to 10 to 11, they had a bunch of puts with very high deltas that they could buy shares against. And I believe they entered risk-free positions, and now they're getting ready for Ford, to go up. And now what they may be doing is buying straddles to hedge if Ford wants to go retrace that move. But what they've essentially done is that they used the straddle before Ford fell to kind of open a pre-hedge. Then as Ford did fall, they were able to buy shares against that hedge in a risk-free position. So that's kind of the mechanics. Let's get into the screens for a little bit. Okay, so we look at some of these screeners. The Straddle screener is my favorite. And I especially want to focus on stocks that generally have lower implied volatility in the value sector. So that's not going to disqualify Apple and Google. I think what's a little surprising, what maybe some people don't understand, is that Apple and Google and some of these big tech stocks that are the highest holdings of the S&P and the NASDAQ, they actually have pretty low implied volatility. I mean, we just talked about Ford, an auto stock having 38% implied volatility. We can see Apple right now is a lot lower than that. Apple's a pretty, as far as the options market is concerned, Apple's almost a pretty stable stock. It's got implied volatility right now of 25%. That's typically something that, I would see on a pharmaceutical stock or on a bank, something that's a little, less sexy. So just because the stock is in the tech sector, that doesn't necessarily mean it's got very high implied volatility. So if we look at Apple and Google, we can see that the implied volatility is actually lower than Ford, even though Ford would probably be considered a value stock, while Apple and Google, a lot of people think they have, they're extremely overvalued, right? We look at the price to book ratio on Google, it's 6.16%. Ford's was a lot. Ford's was like 1.4 something. Google is 6 times above its book value. But despite that, it's still got pretty low implied volatility, only 28%. So being a big tech stock does not necessarily mean that a stock, is too, has implied volatility that's so high, that a gamma scalp couldn't be run. These options would still have relatively high gamma. Now, what would be disqualifying me from buying a straddle on Apple and a straddle on Google? Well, if you look at Apple right now, it's $172. Google is $117, right? So what I said was I generally like stocks to be closer to $10 to $15 because the premiums are going to be much, much lower than a stock that's in the $100 range. Okay, so institutions, they can still be running gamma scalps on Google and Amazon and Apple. I'm going to stay away from those straddles because those are going to have, a lot of time decay because these are pretty high dollar amounts. I normally want to be, between 15 and between 10. So this is the Straddle screener, one of my favorite screeners, and let's look at some of these, meme stocks, right? Meme stocks like Clover Health, like, Wish, we just saw kind of BlackBerry explode recently. We could see, maybe some of these other meme stocks like AMC and GameStop. They're extremely volatile, but I do think that, the volatility that the institutions are preparing for is going to ultimately resolve to the upside. So the Straddle screener, I would say, is number one. I love this screener. The Strangle screener is almost identical. Only slight difference is that a straddle has the same strike, and it's usually the same at the money strike for both options. Not the same story for a Strangle. A Strangle has an out of the money call and an out of the money put. So that's going to be less money up front, which is good. But that's also going to mean that stock's going to need a pretty big move for one of those stocks to be in the money. So remember that an option has intrinsic value and it has extrinsic value. If I buy a straddle on Ford at 15, and Ford goes up to 18, Ford goes up to 19, then the call, the 15 strike call is going to be $4 in the money. It's going to be $3 in the money. It's going to have an intrinsic value of $300, $400. Now, if I bought a Strangle on Ford when Ford was at 15, I bought the 17 call and say the 13 put. Well, now if Ford goes up to 18, I only recently, got in the money when Ford went above 17. So a Strangle is going to take a lot of time to get in the money. And remember that an option that's in the money all else being equal, is going to have less time decay than an option that's out of the money. So the intrinsic value of a straddle is very important to understand. When I first got into straddles and strangles, I was looking at strangles because there's a lot less premium up front because the options are out of the money. What I sacrificed for that was I had a lot lower gamma, because at the money options are going to have higher gamma, and I also had lower intrinsic value. I needed, the stocks to have huge moves just for one of the options to be in the money. With the straddle, the options are almost in the money very quickly. Anyway, so this is the Strangle screener. I love this screener. We see Salesforce on the screener. I haven't seen Salesforce on the screener in a little bit. Applied Materials, I haven't seen on the screener in a little bit. We look at Salesforce. A lot of retail traders, how would they manage risk in Salesforce? Well, they probably use a stop loss, right? Well, so the most, obvious stop loss would be this 78.6% retracement down at 154, right? So a retail trader, they're going to have a stop at 154. And if Salesforce goes below 154, then they're going to be out of Salesforce, for good with a loss, right? And if Salesforce, runs to the hills, then that's going to be great for them. They're going to stay in, but it probably would have been pretty difficult to just keep putting stops, at each of these lows and saying, okay, well, maybe this is the bottom and I've got Salesforce. Maybe this is the bottom. Maybe this is the bottom. What institutions may be doing is that they're buying strangles to prepare for this downside risk. They don't have a stop loss, right? Let's look at what these strike prices were. And remember, for these strangles and straddles, this is all what's free. So this is all what's free from Barchart. For paid people, which I'm not, they can actually go and they can make some of these expiration dates a lot further. So I don't try to pay too much attention to what the expiration date is. But let's look at, next week. So next week, they're buying the 175 put and the 190 call on Salesforce. I'm not saying that Salesforce is going to go above 190 or below 175 in the next week. But we can see how, if institutions have a strong inkling that could even possibly occur, instead of having a stop loss, they could just have a strangle. And by the time Salesforce is at 154, 156, when retail is stopping out, they just have an in-the-money put that they could buy against, or, that they could say was their hedge to begin with. And so they're just going to cash out on their hedge. So anyway, it looks like institutions are very interested in this Salesforce chart. If I had to guess, it's a 1, 2, 3, 4, 5 waves impulse, very clean impulse from this 2018 low. It looks pretty good. Okay, that doesn't guarantee Salesforce is going to go to the moon, and I don't think the institutions are betting on that. But what I think that they are doing is they're hedging for a massive move, and any pullback they do get, they're going to buy against some bloated puts. And then if Salesforce does in fact bottom, well, that's the beauty of a straddle. It hedges for the upside risk and the downside risk. So that's the Strangle screener, the Straddle screener. I'm on those 90% of the time that I'm awake. I'm on these screeners. I want to show a little more fun screeners. So I know a lot of you guys really care about options volume. We'll get into that one in a second. Let's go to this IV rank and percentile screen. I love this screen. So what I do, I go to options, IV rank and percentile, and what I can do is I can sort by implied volatility. So I believe that this screen from Barchart right here is giving me the highest volume and open interest for options in this market. But before we get into that, I forgot one thing. I forgot what the filters are, because I want to prove these are big money filters. All right, I want to prove when a stock is, like Apple making multiple readings, or Facebook making multiple readings across multiple expiration dates. Let's say Facebook was on the Straddle screener and the Strangle screener. It was, appearing with multiple expiration dates, multiple strike prices. That would be evidence that big money is causing this move. Okay, it's not Redditors, and we can prove that. We can prove that if we go up to help. So if I look at help right here, I can see some of these filters. And what I really want to focus on are these liquidity filters because they're pretty damning. We can see that there are all kinds of filters, but the liquidity filters are what I'm looking for. So the options volume filter for both leg 1 and leg 2 must be greater than or equal to 100. All right, so that's 100 calls and 100 puts. being bought for that expiration. Okay, and so that's going to be a little expensive, especially when we see stocks like Apple and Amazon and Tesla making multiple readings. The open interest for both leg 1 and leg 2 have to be greater than or equal to 500. So these are big money filters. They are liquidity screens. It's going to be very difficult for a stock that isn't very highly traded to show up on these. And that's why I think it's, the beauty of these screeners is that, I can look at them and, I see Apple on it all the time. I see Amazon on it all the time. But then maybe I see a stock like UPS that I haven't seen in several months. And I'm looking at a stock like Ford and Petrobras where, maybe it's a little more rare for, some of these less traded stocks, compared to Apple, compared to Tesla, to be on these screens. Hey, wait a minute. Why are the institutions looking at Petrobras and UPS when I know that, these stocks haven't been on these screens for, quite a long time? Anyway, that's the Straddle screen. Let's look at implied volatility, rank, and percentile. So this is a very cool screen. I think I got to zoom out for a little bit. But if I look at the screen right here, there's a few ways that I can filter this. So this is just the initial screen that is given. What I can do is I can filter by implied volatility percentile. So that's what I'll do. So of the most traded stocks in this market, we can see the ones with the lowest implied volatility and the highest volume and open interest that made the top 20 are Ford, Tesla, AMD, and Alibaba. So, we can see that the implied volatility rank and percentile isn't really even that low for some of these. Ford's is 12%, Tesla's is 17%, AMD and Alibaba are 22%. So what people will generally say is that below 30% is considered subdued implied volatility. But really, if I'm buying a Straddle, if I'm buying a Strangle, I want it pretty close to zero to get that little bit of an edge. So I'm going to refresh this screen. And now I'm going to get a whole list of stocks that do have 0% implied volatility, rank and percentile. Canaan Creative, Uranium Fuels would stick out to me right off the bat. Energy Transfer, which I've talked about a lot. 1% implied volatility, rank and percentile. So this is a screen that I like. So what I do is I go to implied volatility, rank and percentile, and then I refresh it. Once I've sorted by the lowest implied volatility, I get a list of stocks that have 0% implied volatility, rank and percentile, seem to be getting, I can see what the options volume is for a lot of these. We see Energy Transfers is at 5,700. Hertz is at 19,000 when implied volatility is low. What that would suggest to me is that all this volume that's coming in on these options are being bought, right? These aren't institutions that are coming in and doing short strangles or short straddles. My, inkling based on kind of logic is that the smart money is buying these options that have 0% implied volatility, rank and percentile. They're not selling them. That wouldn't be a very smart thing to do. If I went into if I was a big institutional desk trader and I told my boss that I wanted to go sell a call and sell a put, or better yet, sell thousands of calls and sell thousands of puts with the 6th strike on Uranium Fuels when implied volatility rank percentile was close to 1, close to 2, the cheapest that the options have been in the past year and a half. That institutional boss that I had probably wouldn't let me be trading with his or her money much longer if I said that I went to go buy a call and buy a put on Uranium Fuels with the same strike and the same expiration, or buy a call and buy a put on ET with the same strike and the same expiration. That might be something that they're a little more interested in. So I like this screener a lot, implied volatility, rank and percentile. Another one that I like to do, I like to go into the ETFs. Do the exact same thing. I can sort by the cheapest implied volatility. We see UVXY. I try to probably stay away from the volatility, ETFs and ETNs. Some people say you don't do TA on the VIX. I'm not quite sure how true that is, but I'm not going to be making any bold bets on data that I see on UVXY and the VIX. The VIX ETNs, they're a little special, I guess. Anyway, the emerging markets ETF has very high volume and open interest while having pretty low implied volatility. But this is the same thing where a lot of these implied volatility rank and percentile readings, they're not even really, that low. The emerging markets ETF, IV rank is 10%. But a lot of these for the IV percentile after that, we're back in the 30s, for the financial ETF. So I'm going to do the same thing again. These are the most liquid, the highest volume and the highest open interest. I'm going to refresh this page, and now I'm going to get a list of ETFs that have 0% implied volatility ranking percentile. The lithium ETF, the uranium ETF, the China ETF. Do any of these guarantee that, lithium's about to explode, that uranium's about to explode, that, China is about to explode? No, it certainly doesn't guarantee that. But what it does suggest, especially after, looking at these screens for a long time, if a lot of volume and a lot of open interest is coming into these ETFs, when implied volatility ranking percentile is pretty low, it's probably that institutions are betting on a big move and buying the straddles and strangles, as opposed to betting on, sideways consolidation and IV crush, and they're selling, the calls and the puts. So all that these screeners give is kind of the next sector to really watch it, the next sector to really look at, right? A lot of, people say, oh, keep an eye on it. These are the screeners that, are the keep an eye on it screeners. And if we think about it, uranium, China, the regional banks, right? The lithium ETF, how many retail traders are really focused on these ETFs right now, right? These are probably the ETFs, probably the stocks that, a lot of people have fallen asleep on. They're looking at, maybe the stock that's made a new 52-week high, maybe some clean energy stocks, because of the spending bill, maybe some, XYZ stocks, maybe they've fallen asleep on the lithium sector. They've fallen asleep on the uranium sector, and they've fallen asleep on the Chinese market. And this appears to be when institutions are buying a lot of straddles and strangles, hedging for a massive move. Now, of course, that move could be to the downside. It could be to the upside, but this is important information for me to know, hey, a lot of people, they're asleep on uranium right now. They're asleep on China. They're asleep on, lithium and regional banks, but the options market isn't. We're seeing a lot of interest in these. So anyway, this is another screen that I like. It's not the best, but I think that this, because it's using the ETF format, is really giving the sectors to look at, especially when we saw a lot of the uranium stocks were on the previous screen. A lot of the Chinese stocks were on the previous screen, and a lot of regional banks have been on the previous screen as well. So this is IV rank and percentile. I like the screen a lot. The last bar chart screen that I'll use is unusual options volume. So I think this one's pretty cool, especially because people, they spend a lot of money on, these big money option screeners. I got someone bought a bunch of puts on SPY, so I'm going to buy a bunch of puts on SPY. What have we been talking about in this video? That options are probably best treated as insurance. They're probably best viewed as insurance. So if an institution is buying lots of puts, there's a good chance, especially if they're puts on an ETF, that those are hedges. I mean, that's just, to be honest, there's a good chance that those are hedges for someone who's actually expecting a big move to the upside. So it's actually the opposite message that a lot of people are getting. But if someone is really interested in looking for, where's the big money going, where's the options volume going, I love this screen right here. Unusual stock options volume is the same thing, where I can sort by implied volatility ranking percentile, and I'm always going to have IV ranking percentile be sorted by the lowest readings, because I want to know, for me, having high volume and high open interest, that doesn't really tell me anything if I don't know where implied volatility is. If the implied volatility is very low and the options volume is unusually high, the open interest is unusually high, that suggests to me that the orders that are coming in are buying the options. They're not shorting the options. They're not doing short strangles and short straddles. My bias would be that the smart money is doing long straddles and long strangles. And, after keeping track of these screeners for a while, that tends to be what appears to play out. So I love sorting by this. We see DCP midstream, a midstream stock, 5,400 to the call side, 979 puts. So in 579% increase in option volume for the past month. So a lot of money came in when options were the cheapest to the call side. So that doesn't guarantee that DCP midstream is going to explode to the upside. It probably means that calling the top in oil is probably a bad idea at this point. Like I said, these could be hedges. They could be loading up all these calls to hedge a big short on DCP. If I go click on DCP, I'm going to guess that, it's a pretty high dividend stock. It's a pretty strong value stock. It's got 1.34 book value, only 34% above its book value right now. So I would guess that the implied volatility ranking percentile being this low would be a sign that institutions are more interested in hedging than shorting DCP, if I were to guess. So that doesn't guarantee that DCP is going to explode to the upside. Here we see Energy Transfer again. On this screen with 0% implied with 3% implied volatility ranking percentile, 4,300 calls, 1,600 puts. So we see time and time again that ET is showing up with very cheap implied volatility and a lot of money coming in to the call side. Uranium fuels, the same thing we just talked about, how the uranium ETFs were on the prior screen. Now we see uranium fuels has a lot of money coming in when implied volatility is very low, and it looks like a lot of those bets are to the call size. So that doesn't guarantee uranium fuels is going to go to the moon, but if we look at the chart of uranium fuels, we see that a lot of the money is coming into the call side. What could be happening, they're taking a speculative upside position in uranium fuels, and maybe they're using some of these puts, some of these options they're buying on the uranium ETFs to hedge the downside. My expectation is that uranium fuels is getting ready for a move to the upside. So how would most retail traders be trading this? Well, they'd have a stop at 4.32. And then they'd have the upside targets. My upside target would be the length of wave 1 placed at the wave 2 low. Gives a minimum wave 3 target of 11.80. We can have a shallow wave 4 and a wave 5 higher. I would actually say that if UUU gets running, it's going to go a lot further than 11.80. That would be the minimum wave 3 target before a shallow wave 4 and a wave 5 higher. So what's the appeal for an institution? Well, they don't really have to have a stop at 4.32, and they don't really have to have a price target of 11.39 either. They could just buy a straddle, right? They could just buy a straddle, and they could either be buying a straddle outright, or they could be buying a straddle to hedge a current position, or they could be buying a straddle to hedge a future position. So let's say I bought a call and a put on UUU, and let's say that it expired in 9 months, okay? And then let's say that uranium fuels has another dip lower, right? I'm wrong about uranium fuels. It hasn't put in wave 2. It's going to go all the way down to below 4. It's going to go down to, 3.50, and I'm going to have a $6 put that's $2.50, $3 in the money. Well, one, I've got a profitable straddle. I just took a directionless bet, and I just made money to the downside. But what can I also do? I can go buy shares of uranium fuels against that bloated put that's $2 or $3 in the money. And I could exercise that put, or an institution could exercise that put if they wanted to. And then their position in uranium fuels was essentially a risk-free speculation. So anyway, that's UUUU. That's one of my favorite screens from Barchart. I sort by lowest implied volatility ranking percentile, and then I refresh the page, and then I'll get a lot of these readings. So this is a very similar one where I can go to these ETFs too, do the exact same thing, where I can sort by the lowest implied volatility ranking percentile. We can see the emerging markets are showing up again. Remember the prior screen before the more recent one, we had the emerging markets at the top of the list, right? And how many traders are thinking about the emerging markets right now, right? How many? Probably not a lot. Just to be honest, probably not a lot. ARCX, right? Who's thinking about the space exploration ETF right now? We see that its options volume is 198% higher than the past month. 520 calls to 22 puts. Doesn't guarantee ARCX is going to explode. This could be hedging a big short on some of the space exploration stocks, but it's important to note, hey, wait a minute, when was the last time I saw a chart on FinTwit of the space exploration stocks? That's kind of a sector that a lot of people would laugh at. It looks like the institutions aren't laughing as much as they're loading up right now. And then this one is pretty interesting. QILD, 1,700 puts to 528 calls, and we got basically 94% increase in options volume for the past month. So I would hope that this is a massive hedge for QYLD. The institutions own a ton of QYLD. They're collecting that massive dividend, and they're using these puts, kind of running the married put strategy to hedge that position too. That would just be one thing I get. So I haven't even refreshed this page yet. If I do refresh this page, it's going to be a very similar thing. So this is the last bar chart screen. If I do refresh this page, I think one thing that's fun is to see the leveraged ETFs that are showing up, especially if they're showing up with the non-leveraged ETFs. We talked about China. We talked about some of these VIX ETFs. But the emerging markets in China, being a very similar theme, where institutions are preparing for a massive move. We're seeing some of these gold miners, gold, GLD, IAU, another gold ETF, showing up on these screens, where maybe a lot of retail traders have really kind of given up on gold and silver. It appears that the institutions have just started to continue to load positions. If we look at gold right now, GLD, 2% increase in 1 month options volume. We see 79,000 calls, 21,000 puts. So a lot of people, they're paying all this money for big money option screeners, and it's all free. It's right here. Gold, GLD, 9% implied volatility rank. And we got basically 3.5, 4 times more calls coming in than puts. Doesn't guarantee anything, but it's going to change the way that I look at the gold chart, especially if people are just thinking the gold's just going to stay flat, for the next year and a half, because that's what it's done for the past year and a half. That's probably not the case. So these are the bar chart screens. We won't look at Canaan Creative, but I want to go to iVolatility.com. Another free screen. These are all free. This one, I do believe an email account has to be made, but it's the same idea. I'm looking for stocks with low implied volatility, rank and percentile, with high volume and open interest. So this is a very interesting screen, because you can only see stocks that are in the top 200 options volume. So that's very interesting. If we think about the thousands of tickers, the thousands of stocks, hundreds of ETFs, you have to be in the top 200 just to make the screen, just to even qualify. You have to be in the top 200. So this is a very useful screen to me. We see United States Steel Corp and Gilead Sciences in the value sector. So if I have a straddle on a value stock like Gilead, like USX Steel, I think Gilead would be a very good example, because Gilead pays a pretty nice dividends. Let's look at the Gilead chart for a little bit. When was the last time you saw a chart of Gilead on FinTwit? I'm going to be honest, I haven't seen a chart of Gilead on FinTwit for a long time, but I've seen that CVS and Merck, or not Merck, oh my gosh, CVS and Bristol Myers Squibb, my bad, are going towards this 2015 2014 high. So a lot of people are going to say, well, Gilead, CVS, and Bristol Myers Squibb, they're rivals, right? They're competing. Well, yeah, they're rivals, but they're also in the same sector. So what could be happening, if we look at the CVS chart and we look at the Bristol Myers Squibb chart, they basically make highs in 2015 and 2016. I've talked ad nauseum. Pfizer's broken out of a 20-year base. I missed AbbVie, same thing, breaking out of a 3 or 4 year base. A lot of these healthcare stocks have really outperformed. Really kind of the unsung story of 2022 was it wasn't just energy in the first half of the year. It was, the healthcare. A lot of the pharmaceutical stocks did really well. But anyway, we see stocks like CVS going towards this 2015, 2016 high. We see possible setups right now in Walgreens. I haven't talked about Walgreens a lot, but CVS heading towards this high. Bristol Myers Squibb, I believe, already above this high. And kind of a similar stock that, I bet a lot of retail traders have fallen asleep on, for the past 4 or 5 years. Now we're seeing it while it has 0% implied volatility, or close to 0% implied volatility ranking percentile. It's showing up on these massive liquidity screens, right? So what's probably going on? Are institutions, are they going in and are they selling calls and selling puts that are at the money on Gilead right now when options are the cheapest they've been in the past 52 weeks? I would guesstimate no. They're not doing that. They're probably buying straddles and strangles because Gilead could be following CVS. It could be following Bristol Myers Squibb. And what's an interesting thing about Gilead and those other stocks is that they're dividend payers. So that's another reason I like to focus on stocks that are in the value sector, is because if they're paying massive dividends, it kind of further supports the idea that institutions are going to be hedging large positions with straddles than maybe trying to time the big short with them. So what could happen right now if I bought a straddle on Gilead that was $65? I got the $65 call, the $65 put, expiring in 6 months. I have a straddle on Gilead. What are kind of some of the scenarios? Well, scenario one is that Gilead flatlines. It goes flat for 6 months. I lose all the money invested because that's what a straddle can do, especially one that expires in 6 months. It can decay. Okay. So if I'm someone who wants to accumulate lots of Gilead and I want to take more and more time to buy even more, well, that might not be a bad thing, especially if I'm collecting pretty large dividends and I'm mostly using the straddle to hedge, okay? But, obviously an institution wouldn't want Gilead to just flatline after they bought a straddle, and that's why it's helpful to see these liquidity filters where we can see, okay, it's not just me if I buy a straddle on Gilead. It's the largest players in the options market are buying straddles on Gilead. So it's not just me who's going to be screwed if Gilead flatlines. It's going to be the institutions as well. So that's why these liquidity filters are so important. It lessens the likelihood that Gilead's just going to flatline at 65 for the next few months. But keep in mind, Gilead does pay a dividend. So what could happen? Well, my suggestion or my guesstimation is that the institutions are using these straddles on Gilead to hedge. So let's say I have a 65 call and a 65 put, and Gilead starts to go down and tank pretty aggressively to 45 to 40 to 50. Well, then that put's going to be pretty deep in the money. And since Gilead's a value stock that generally probably doesn't move a ton, it's going to be very low likelihood priced in by the options market that Gilead's going to go retrace that entire move by the time of the expiration. So the put delta would be extremely high. If the put delta was 90 to 95, what I could do, I could go buy 95 shares of Gilead against that in the money put. I could collect the dividends, and if Gilead keeps falling, then the delta of the put would go up to 100. I could add 5 more shares and have a completely delta neutral position where I'm collecting dividends from Gilead. And if Gilead keeps crashing, I can exercise the put. If Gilead recovers and starts to go up, the gamma is going to kick in. The put delta is going to get smaller and smaller, but I'm still going to have 100 shares, and so I'll be in a long position that I entered, basically risk-free. So there's a few more factors, that go into it than that. That's the general idea. If they buy a straddle on a value stock, especially one that pays the dividend, and the stock falls afterwards, they can buy shares against the bloated puts and have kind of a risk-free trade, because the gamma is going to kick in if Gilead recovers, and the delta is going to be 100 if Gilead keeps crashing. And 100 delta put is the same thing as being short 100 shares of Gilead. So it would be a delta neutral position, and I would be basically at break even if Gilead kept crashing after I bought it. Anyway, what could happen to Gilead is it could go to the upside, right? It could go to the upside. I've been using these straddles to buy, lots of shares, but also just, to buy straddles when implied volatility was really low. And if Gilead goes wave 1, wave 2, starts heading into the 80s, starts heading into the 90s, the straddle's going to profit. I can raise the strike prices of the in-the-money call. I can do a lot of things. I'd be in the driver's seat. And so, that would be a good situation to be. So what could happen is, let's say Gilead goes up to 80, 85. Let's say I didn't, buy a bunch of shares of Gilead before. I've got a deep in-the-money call now on Gilead, and the call delta is 90. The call delta is 95. In theory, I could go short 90 to 95 shares of Gilead against that in the money call. And if Gilead, goes up and I short, 95 shares, and then Gilead reverses and crashes, then the delta of the call would get lower and lower, but I'd still have 95 shares And so I'd be in a net short position. There was essentially a risk-free speculation because if Gilead had kept going up, the call delta would go up to 100 and it would cancel out 100 shares that were shorted. Anyway, that's Gilead. Let's look at some of these other stocks. Let's look at some of these other stocks on this screen. I love this screen a lot. There's only 5 readings. USX Steel is another one. Lucid Motors and Rivian are on this screen. So these are extremely risky. These, I would not say, are guaranteed to go to the upside. But what could be happening? Let's say that Lucid Motors had been on the screen for a little bit, and we noticed that these kind of same straddles and strangles have been being bought on Lucid Motors, while the implied volatility ranking percentile was very low. What could be happening is that there's a few things. So as Lucid Motors drops, since it's a very risky, highly volatile growth stock, it's not going to have as high of gamma as the value stocks we went over, like Gilead, like a stock in the oil sector like ET, even a stock that's in the S&P 500 like Apple. It's going to have very, very high implied volatility. We can go look right now. The implied volatility on Lucid Motors is 76%. That's over 3 times what Apple's implied volatility was. Well, implied volatility ranking percentile is still relatively low. So because Lucid Motors has very high implied volatility, it's going to have much lower gamma than some of these other stocks. But it's still the same idea. It's just a little more dramatic. So since Lucid Motors is a very volatile stock, it's going to take a deeper drop for that put delta to get very large. So remember, for Gilead, for some of the other value stocks we went over, like Ford, like Apple even, if I have a straddle and the stock drops 7 or 8%, then the put delta, when it's in the money by a couple of dollars, is going to be very high. It's almost going to be priced in close to 100% chance that the put is going to expire in the money because those stocks have lower implied volatility. They're less likely to make a big move and then retrace all of it. Lucid Motors, on the other hand, is the opposite. It pretty commonly could have an 8%, 9% up day and retrace all of it, and vice versa, have an 8%, 9% down day and retrace all of it. So when Lucid Motors drops, it's going to take a deeper drop for me to have a higher put delta. Okay, so I can still buy shares against Lucid Motors, but let's say that because the gamma is a lot smaller, instead of an 8% drop giving me a put that has a delta of negative 95 like it would for a value stock, maybe now after an 8% drop, after a 9% drop, the put delta only has a 65% chance of being in the money at the time of expiration, because there is a good possibility because Lucid Motors is so volatile that it retraces the move. So the gamma scalp doesn't work as well on the growth stocks, but it's important to note that it does give a sign, in my opinion, that institutions are very interested in loading up these extremely volatile stocks. So what could be happening to Lucid Motors? Let's just kind of think about Lucid Motors generally. It's a stock that's IPO'd recently. It's got extremely high upside potential, and it's a stock that a lot of retail traders are in love with. It's kind of what we would call a cult stock, where some retail traders are just in love with it, right? They think Lucid Motors is going to change the world. So what did they do? Did they take small positions to compensate for the high beta? No, they did the opposite. They loaded the crap up on Lucid Motors, and they probably even did it on margin, right? They think Lucid Motors is the next big thing. Fundamentals are good, so that means that the price is going to go up, and it's the next Tesla. Well, the problem is that Lucid Motors could be the next Tesla, just like NIO could be the next Tesla. But the problem is that Tesla wasn't easy. Tesla was extremely volatile. That's something that a lot of people don't like to talk about, is that the next Amazon, the next Tesla, the next Bitcoin, the next Nvidia, they're not going to be easy. And we know that because we can look at the current charts of the current, monsters that are trying to be replicated. We can see, oh, wait a minute, the current Tesla isn't easy, right? The current Amazon isn't easy. So what could be happening is that the institutions, they're using lots of straddles to hedge their position, because they know if they drop Lucid Motors deep enough that they're going to get every margin trader and every retail trader stop and they're going to be able to get all that supply that they can load up against the bloated puts. So one example I'll give, maybe a little more practical than Lucid Motors. I do think that Lucid Motors is going to end wave 2. The only way to define risk with a stop is this low right here of 13.25. But what's more likely is that the institutions, they're not using a stop loss to manage risk to the downside. They're using a straddle, and they might even be hoping that this low gets broken, because that's going to be a common stop for a lot of retail traders. It's going to margin out a lot of traders, and they can load up against the bloated put. So anyway, that's not really what I'm projecting for Lucid Motors. I think Lucid Motors is extremely dangerous to short. I am expecting this implied volatility is going to resolve to the upside. But let me give a little more practical example of what could be happening. It could take a long time for this to resolve to the upside for Lucid Motors. I think Tilray is an example of a growth kind of sector where we've seen tons and tons of straddles being bought, tons of options activity on this way down. And what I expect is that they knew all the retail traders were in love with the pot stocks, right? They thought that, there's going to be legalization. They're going to take over the world. And you know what? They're probably right. They're probably right that the pot stocks are going to be this next huge kind of commodities related growth sector that really, has a bunch of zeros added to the current prices of ACB, of Tilray, of Sundial, of CGC. And I know that sounds like a joke, but that's kind of the point, is that they always kind of sound like jokes when they're growth stocks. And so what I expect is the institutions have been using lots of straddles and strangles on this pot sector for a bit. And what they've been doing is that they've been using these corrections to not only buy against the bloated puts, but also now they can push out all the retail traders on margin, and they're not worried about Tilray going to zero because they have a lot of puts, and they can exercise those puts when they want to and get as much of the supply as possible. But eventually, I do think that Tilray's implied volatility is going to resolve to the upside. So we got the election coming up. I'm not, a political scientist or anything of that nature, but we see a lot of these political sectors like firearms, like pot stocks, are getting these crazy readings on these liquidity screens, and it just, there's a lot of signs that the MMs are betting for a massive move. And while retail has, not just fallen asleep, but the pot stocks have become a joke, right? I mean, they have. And that's kind of the whole idea, the next, Amazon was a bookstore, Beyond Meat right now, it's kind of a joke. Right. A lot of these growth stocks are just kind of jokes. If you told someone, you were going to go buy a Lucid Motors or Tilray or, some of these altcoins, right? They'd say you're a retail trader getting scammed. And that's, kind of the whole point, is that the MMs, they don't care about being wrong. They're not playing the right or wrong game, because they entered these positions and they had hedges before they even entered them. They had already bought the puts and the straddles that they needed. So if they're quote unquote wrong, they can just exercise those puts that they've been buying this whole time. And what I eventually expect is that they're getting all the traders out because they have, they managed their downside risk, a long time ago. And they know the retail traders didn't. And so as, Tilray, it's the cruel irony, because as Tilray becomes more and more of a joke, those puts become deeper and deeper in the money, and the institutions can load up. And that's what I eventually expect to happen to Tilray. These, fibs aren't very useful right here, but, 2.43. If Tilray is above 2.43, pretty rare risk reward right here for a stock like this. Even if Tilray went below 2.43, I wouldn't be surprised if it was just a little bit of a scam wick before the rally. But anyway, I got a little off topic. I just wanted to talk about why with growth, it's a little different, because these stocks have much higher implied volatility. So it's going to take it's going to take a bigger move to the downside for the puts to have very high deltas, whereas a value stock, it's going to take a relatively small move to the downside for a put to have a high delta because they have a value stock moves less, there's less probability it's going to retrace the entire move, where stocks like Lucid Motors, stocks like Rivian, there's a much higher percent chance that they could have a big move and then retrace all of it. So they're going to have less gamma, which measures the rate of change of an options delta, which measures, among other things, the probability that option will expire in the money. So here's my last screen. This is from marketchameleon.com. I really, love this screen. This is a very interesting one. I haven't shared this one before, but marketchameleon.com. So this is all free. The most that anyone's going to be asked to access this is an email address. Okay. I don't even know if I needed my email address. I haven't even logged in. This is all free. Marketchameleon.com. Go to options, implied volatility rankings, and I'll show you guys the filters that I use. You can probably guess. I'm looking for IV down. I'm looking for IV rank to be subdued below 30. And I'm looking for open interest rank to be above 70%. So this is a very useful one. I haven't found many stocks that have open interest rank as something that can be used as a filter. We don't have too many readings on this, but what you can see is that it gives the open interest rank and it gives the implied volatility reading. So I'm going to try to find, we see Johnson & Johnson, 88% open interest rank. When implied volatility, it looks like it's around 12%. So this is using the 30-day implied volatility rank, but this is another screen that's using open interest rank with low implied volatility. So the same kind of idea. It's just another liquidity filter. We see that United Health, 97% open interest rank, and we see Johnson & Johnson, 88% open interest rank. Another one, where, hey, the options market is looking at the healthcare sector pretty aggressively, and that's probably not a sector that too many retail traders are super, super excited about. So this is a little interesting. WBD, Warner Brothers Discovery. I think this is a newer ticker. Let's see what WBD looks like. I think that this. Let's see. Why would the institutions be looking for a big move in this stock? That's really the only question that I asked. Why would the institutions be looking for a big move in this stock? And to be honest, I'm a little dumbfounded with this one. We'll see. I'm not quite sure. They're making it difficult. I can say that. We got this low of 12.77, and they've come within 9 cents of it. So we can see why they're using probably straddles and strangles to manage risk right now in WBD, because the stop loss isn't really too worthwhile. What they could be doing, I don't know too much about WBD, but what they could be doing is that this is a stock that a lot of retail traders fell in love with, and then they've been using straddles to kind of frustrate them to death as they get close to this low. And they could be going wave 1, wave 2, wave 3 to the upside. WBD has been on a lot of these screens, but just one to think about, would a stop of 12.77 when this highly volatile stock's at 13.61, would that be very useful? Probably not. They're probably using straddles and strangles, but just go watch. Well, watch what happens to WBD. This is going to be a stock that's trending on FinTwit and the forums pretty soon. And I would say for this screen particularly, just make a list of these stocks. Peabody, watch what happens to Peabody. Watch what happens to Hershey's. Watch what happens to United Health. Oh, we do have some more. Oh my gosh, I thought we only had a few of these. Oh man, my bad, guys. I thought that we had only a few readings. It looks like we got a whole bunch of these. So Omega Health, let's look at OHI for a second. This is a very good example of a value stock that pays a high dividend, where I just got to ask, so implied open interest rank is at 100%, while implied volatility is really low. So in the past year, we've never seen more open interest on Omega Healthcare than before today. So that's very interesting. Let's look at Omega Healthcare And just look at a few things. The price overview. So that's a very interesting one to look at. We see the price to book ratio is 1.98, 98% above its book value, which is a little interesting for a REIT. Typically REITs, that's when you can get a little lower than book value. The beta is 1, so it's trading perfectly in line with the S&P almost. And look at this massive dividend of 8%. So let's look at this. It's a huge dividend of 8%. So what this would kind of lead me to believe, especially given the implied volatility is only 22%. Remember with Apple, and some of those other stocks we were talking about, that the implied volatility being at 20%, that's kind of about as low as it can get. Not as low as it can get, but below that, we might be talking about a stock that doesn't move at all, right? So 20 to 30% is really kind of the sweet spot. I'll really even go up to 35. 40% for general implied volatility if I'm buying a straddle. But this is a straddle that's going to have very high gamma because this implied volatility is so low. Let's look at this chart real quick. And remember, this stock pays the 8% dividend. So are they using these options probably to bet on a big move? They're loading up. They're loading up for the big tendies. I don't think so. What they're probably doing, they're using these options to hedge for a move in any direction, particularly to the downside. My guess would be it's because they have a lot of option straddles and a lot of option strangles. So what they could be doing is that while everyone's, who's talking about the healthcare REIT sector right now, right? I would guess there's not going to be a lot of charts of the healthcare REIT sector right now, even though a lot of these names are paying 8% dividends. So what I would expect is that with open interest rank and a 52-week high, on some obscure, healthcare REIT like OHI, that the MMs are preparing for a pretty big move when a lot of traders have kind of fallen asleep on this sector. Okay, so OHI in the healthcare REIT sector, MMs are expecting a big move. It pays an 8% dividend, and they're loading up options when implied volatility is low. So does that mean that it's a surefire thing? OHI is going to go to the moon? No. But what that would lead me to believe is that the biggest players in the options market have a lot of shares of OHI, and they're hedging for a massive move. And they're not just hedging for the downside. I think they're also hedging for the upside as well. Let's watch what happens to OHI. But what could this be? This could be a 1-2-1-2 Elliott wave nest, and this stock that's currently paying an 8% dividend yield is going to have a much smaller yield because the price is going to go to the upside. My guess is that the institutions are hedging for a massive move. They want to keep holding those huge dividends they're going to collect from this stock, and they're using options to prepare for the downside risk and the upside risk. If OHI goes down after they buy a straddle at $33, they can buy shares against the bloated put. If OHI goes to the moon, then they're going to profit from that move to the upside, and they already loaded up. So anyway, these are my favorite option screeners, how I use them, and I hope you enjoyed this little more laid back video, how I find stocks that the institutions are looking at when everyone else is kind of bored of these losers that don't move.